question number 2 asks us to make the total asset section, for which information have been provided, delimited, all the ratios have been calculated, sales and purchases were on credit, closing inventory was 20% higher than the opening inventory, which means opening inventory is X, and closing inventory is 120% higher than that, which means 1.2X, as opening inventory is X. We have the current assets, inventory, trade receivables and cash equivalents, and current liabilities, trade payables. We will do all the workings first, and then we will accumulate all those workings and make the part of the statement of financial position. So now first let's start with the working. For the working, we'll go by order. So first of all, we have been provided with the gross profit margin. Now if you look into the gross profit margin formula, it is GP, which is gross profit, divided by sales into 100. Hence the GP is X, we don't know. The sales are on credit 1051,200 into 100, and it is given as 40%. If you solve this, you get to the answer as X is equals to 420,480. Alright, now through this, why is it important? We are going to make non-current asset position or current asset statement. Why is gross profit included? We are going to calculate all things that have been recorded. We are going to first make a short income statement format till the gross profit. We are going to calculate opening inventory, closing inventory, cost of sales, purchases, everything, and then we are going to make that on. So that was required. We've made the gross profit, we get the gross profit, we know the sales. So some part of the income statement has been complete, so we'll write that side by side so we know how much have been done and how much more do we need. Alright, now so I have made a small income statement format till the gross profit. I have just written the sales. Cost of sales, my opening inventory is X, we don't know yet. We can add the purchases. We've given the purchases amount as 642,400. So we can write 642,400, and we have the closing inventory as 1.2 of X. As opening inventory, we don't know how much is that. We don't know what's cost of sales total, and GP is 42480, which we have now calculated. Alright, if you think carefully, if you look at the statement, you can know that 105120 minus cost of sales gives you GP. So you can do the backward working and you can calculate the cost of sales. Hence, your cost of sales will be very easy to calculate and will be as 630,720. So cost of sales have been calculated, GP is there, sales is there. Now opening and closing inventory are left. We can also easily do the working of opening and closing inventory, which will now I'll show. Alright, so now working of the opening and closing inventory for the cost of sales section. This format we are going to write it horizontally. For instance, like opening inventory plus the purchases, we do not have any carriage inwards. We are going to subtract the closing inventory and we are going to reach towards cost of sales. Now we are going to fill in all the figures to get towards the opening and closing inventory. We know the opening inventory is X. We know purchases as 642,400. Closing inventory as 1.2X equals cost of sales as 630,720. If you take this there, you solve it and you subtract 1.2 from X, it will be 0.2X, which is going to be negative. You can ignore the negative sign and you get this as 11680. This is also a negative answer, hence you cut down all the negative answers. You're left with this equation. If you solve for X, you get as 58,400. So what is this X? If you look back, X is the opening inventory. So 1.2 of X, which means 58,400. If you put this into the calculator, you get the closing inventory as 700,80. So this is basically the closing inventory. Now through the formula, we have gotten the opening inventory, we have gotten the closing inventory. It is highly simple. You just put in the figures, you solve the equation normally how you do in a basic math equation question. You take this there, you subtract 1.2 from 1. This is basically X ke saath is always 1. is 0.2x. You solve this, that is 58400, which is opening inventory. And we decided that 1.2x, because closing inventory is 20% higher than x. It is 1.2 of x. We got this. We can fill in this equation. All the income statement section has been complete. Now we look on to the other formulas. Now if you look into the other information, we have the non-current asset turnover ratio, we have the trade payables turnover ratio, we have the trade receivable turnover ratio. Now for the non-current asset turnover ratio, we know the formula as the sales over the net book value of assets, and that is the answer in times. That is all that is being provided. We know the non-current asset has been given as 2.4 times. The sales 1051,200. It is as we mentioned here. We do not the net book value of assets. We do not know this. Hence the X is going to be 438,000. Non-current assets as this. So if you make the non-current asset section, you will get to know how you're going to put in the figures. Right now, so I have also drawn the statement of financial position extract till the total asset section. Non-current assets, as I have stated, 438,000 have been written down there. The current asset section consists of three things: the closing inventory, trade receivable, cash and cash equivalents. Inventory closing is 70080 that we extracted from the income statement. Two things have been left, and we will receive till we reach towards our final answer. Next thing that we are supposed to calculate is the trade receivables turnover, because we do not have this amount. So trade receivable turnover has been given as it is trade receivable over sales into 365 the days. So we know that 33 days have been given. Trade receivable is the value that we don't know, and sales is 1051,200. Hence it is extremely easy to calculate the value of X. You put down all this into the calculator and you get the trade receivables as 95040. If we look into the information, we have covered all of this. They say that trade payables ratio has also been provided. There is no need for that up till now. But if we look at the cash and cash equivalent section, that has been incomplete. We do not have any information which can help us calculate cash and cash equivalents directly. Hence, if you look into the information, the current ratio have been provided. To explain you further, current ratio is basically current assets over current liabilities. This is the formula of current ratio. We can use this formula to calculate the cash and cash equivalents, and this is why you need to know the formulas very deeply and understand them. Where are they required when you're calculating the missing figures? Right now, so this is the formula for current ratio. We will given current ratio as 2.2. Current assets, you will add the current assets 70 plus 95040 plus X is the cash and cash equivalents that you don't know up till now, and the current liabilities only consist of trade payables. Now we know that trade payable turnover has been provided. It is the trade payables over the purchases. The purchases are 642,400 and the days have been given as 45. So you can calculate the trade payable easily, which is 9,792,100. So current liabilities only consist of trade payables. This is the working for the trade payables, and you can easily calculate this amount. Now after these calculations, you get to know that 2.2 is the current ratio. You have all the information. You can calculate the value of X. Hence the value of X is 9120. So you take 79200 there, multiply this, and you're going to subtract these. You're going to get the value, and now easily we can calculate the total asset section. So this was all that you were supposed to do. If you look here, we have this income statement section complete. We have the statement of financial assets complete as non-current assets. We've listed down all the things. We have the total assets, and this was all required. Now the work is extremely important. If you write down any incorrect figure, you will be awarded with marks if you've done the correct working. is there any calculation, because a lot of calculations involved. You may mess up the calculation section, add or subtract. So you need to show all the calculations clearly in order to get full marks. If you have just listed down all the wrong figures or there have been errors, that can be corrected through that. Alright, so the next question asks us to calculate the working capital cycle in days. So now first let me clear you that working capital cycle formula. It is the trade receivable turnover in days, because it has asked us to calculate in days. We're going to add the inventory turnover in days, and you're going to subtract the trade payable turnover in days. So basically this is the formula: trade receivable turnover in days, add inventory turnover less the trade payable turnover in days. Now we will do the calculation for all of them and get to the answers. Mentioned in the question, we have the trade receivable turnover in days as 33. We have the trade payable turnover in days as 45. The only thing that we're supposed to calculate is inventory turnover in days. Alright, inventory turnover in days formula is basically the inventory, the opening plus the closing. You're going to add this opening plus closing divided by 2 divided by the cost of sales. So basically this is the formula for inventory turnover in days. For times it is the opposite, cost of sales divided by the inventory turnover. So for the opening and closing inventory, we know that 70080 is the closing inventory. The opening inventory is 58400. You're supposed to divide it by 2, and you're going to divide the cost of sales. So the cost of sales is basically 630720. So all these information has been taken from the previous question. We listed down all these. After the calculation of inventory turnover, you get the answer as 38 days. 38 days is the answer. You're going to add 38 to this, subtract 45 to it to get the working capital cycle as 25 days. So everything was required to be calculated in days. Trade receivable and trade payable turnover were given. We calculated inventory turnover as opening plus closing divided by 2 divided by the cost of sales is basically for days. For times, you're going to flip this and get the answer as working capital cycle as 25 days.